My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to not lose a lot of money and put it in context. So we're going to try to teach and educate and make it clear what you can do in this environment. I want you to call me at 1-800-743-CNBC or tweet me at Jim Cramer. Even after today's relentless beatdown, Dow plunging 569 points, S&P plummeting 2.04%, NASDAQ nosediving 2.83%. I don't think the sell-off's necessarily over, although you can never be too sure because there are so many things going wrong at once that we could mount a nice rally even if anything gets a tiny bit better. Now, I find it impossible to be philosophical about losing money. And it's kind of like this, it's not just financially devastating, it's emotionally devastating. That's why I've developed a set of rules that allow me to at least keep calm when the market's rolling over. I need you to adopt these rules so you can think clearly and not say, oh my, down 2.8%, it's time to go. Instead, I want you to be opportunistic. The first thing you need to do, though, before you can be opportunistic, you got to nail down the proximate cause. What proximate cause of the sell-off? What happened here? Right now, you hear, well, it's bonds, it's interest rates. But does that really tell you anything? What is really going on with bonds, interest rates? How can the Dow dip into the red for the third quarter? How is it possible that the NASDAQ could be down 2.8%? Okay, I'm going to tell you. First, inflation is proving to be more ingrained and less transitory than Fed Chief Jay Powell originally predicted. In fact, inflation is actually accelerating, which makes the Fed's forecast for a calmer moment seem increasingly unlikely. He needed to see decelerating. He got accelerating. Now, Jay has plenty of wiggle room. He can say that inflation will be under control sometime next year. However, there are real signs of overheating everywhere. We learned that housing prices were up 20% year over year in July, which is terrific if you're already a homeowner, but real bad if you're trying to buy one. Mortgage rates starting to go higher. That will make homes even less affordable. We know that home builders are going full tilt to add capacity, but it doesn't seem to be enough. And by the way, that's a negative for the home builders. While the economy may not be overheating yet, when you see that kind of action, it means that things are getting too hot to handle. And that's why the stocks of the home builders are just being crushed, even though you hear of tremendous demand. Of course, this is not a normal economy. So historical precedent can only take us so far. See, home prices are going up for a variety of reasons. Most of them still boil down to COVID. People are working home, so they need more space. They didn't come back. I speak to so many CEOs. They're talking about February, March now. Now, this wasn't in the cards when the pandemic got rolling, so the homeowners didn't prepare for it when they made their plans long before the year began. That's why all the inputs for new houses are still in short supply. We aren't in a position to quickly build more in order to meet the demand, in part because we simply don't have enough workers. New homes are in such high demand that the home builders can pretty much raise prices at will, but that can't last. It's another reason why their stocks keep going lower. They're sucking you in. Remember, we had Ivy Zellman on? Now, I got to tell you, Ivy Zellman, you might have missed this on Friday, but she is so bearish. I'm afraid she's going to be right. I'm afraid she's going to be right because we got accelerating inflation, we got higher mortgage rates, and we can't get these homes built. Next problem, something I didn't see coming, it's natural gas. Now, we've done a couple of pieces that were positive. We had Sharif Suki on, we had Carly Garner on the charts, but natural gas is crushing us. After bouncing around the bottom for ages, it's down more than double this year. That means your winter heating bill will be a lot more expensive this year, thanks to hurricanes and lack of pipeline capacity. But you want to understand that. See, we know the price spike can be a real confidence sapper because it always comes as a surprise and always comes at Christmas time and always cuts into retail spending. We've gotten so used to abundant natural gas in this country that most people in their 30s or on down, they can't even recall a time when their heating bill doubled. Gasoline's going up, too. Price of crude keeps climbing, Brent hitting $80 a barrel before pulling back a bit. Now, because the price of gas is posted, you tend to dwell on it more than, say, the price of milk. Be glad we aren't in Britain, though, where they have gasoline but lack the truck drivers to get it to the gas station. If you wanted to ask me which one's going to peak first of all these, I will say natural gas. The reason is because both Sharif Suki from Tellurian and before that from Cheniere and Carly Garner said 6 to 7 is where it's going to peak. Now, third, we got a supply chain nightmare that nobody saw coming, and we don't know how to solve it. That's what's so we don't know how to solve it. We didn't realize our economy was so reliant on imports. Our port system is set up for much less traffic. Plus, our intermodal shipping containers are set up to flow from west to east, not vice versa. So now the containers are in the wrong places. Shipyards aren't adjusting to the new traffic. Do not ask me why. Meanwhile, truck drivers are in short supply. So getting things onto trains has been a nightmare. I was hoping we'd get some relief. But when we spoke to Lance Fritz last night, the CEO of Union Pacific, he didn't offer us much comfort. He said we need the pandemic to end if we're ever going to get back to some degree of normalcy. I found myself begging Lance to give me some positives, and he wasn't going to give me them just to make me happier. That's not the way he thinks. Which brings me to number 4. I'm going to keep coming back. COVID's got to end, all right? It's just got to end. We don't know how many people are staying out of the workforce because of the pandemic, but it's probably a lot, maybe as many as 10 million. We know there are jobs where you made $18 an hour before the pandemic that now are $22 an hour jobs, yet they still can't find people to work. Have you been to a restaurant that didn't have a help wanted sign? I was hoping those signs would be down by this point. If they come down, though, they're only to be replaced by signs that say they're closing at various convenient times because they can't find enough staff. Very European, and not in a good way. More on this point later in the show. Fifth, I'm of two minds about this infrastructure bill. Really am. I mean, on the one hand, you have to figure that these big infrastructure projects will create even more wage inflation. Can't find jobs. Nobody, we have so many more jobs than people. On the other hand, given how long it takes for our government to build things, you might not need to worry about that until 2023 at the earliest. Six, this chip shortage is so intractable that I doubt it will be resolved by the first quarter of next year, and I thought it could be. The semiconductors we desperately need still aren't expensive enough for foundries to manufacture them en masse. I wish they would just raise the prices to where they could extract enough value and make more right now. We know automobile chips, which are dumb chips, so to speak, or full features, they like to call them, make up just 4% of the largest foundry's production. That's Taiwan Semi. And they're not going to start making chips, cheaper chips out of the goodness of their heart. Either of these low-cost chips get a lot more expensive or they just don't get made. Of course, in any of this, you see Jay Powell, is he in charge of any of this? I mean, I read about all these people. They attack this guy constantly. Hey, Senator Warren attacked him. I thought that was unreasonable. He doesn't make chips. He doesn't pump oil. He didn't know cashiers need plexiglass screens that are now in short supply. He didn't know we can't make enough plastic. He didn't anticipate that we wouldn't have enough windows or doors or appliances or sinks or tubs or toilets or anything involving, say, like grouting. You know, I mean, hey, floor tile. I can't get floor. If you have floor tile, just give me a jingle and direct message me. Even the home builders couldn't predict this, and that's their business. Every one of these issues stands in the way of higher stock prices. Do not even get me started on the debt ceiling. Possibly a government-mandated default, no matter how fanciful, has pushed bond prices down and bond yields up. When you've got rising interest rates and raging inflation, most stocks are roadkill unless the underlying companies have the ability to raise prices without having to hire more workers. And you know who has that? The only group that goes higher. Oil and gas. Tech in particular is being eviscerated because the whole group is allergic to higher interest rates and inflation. Problem is the market's been up for so long that we're practically due for a pullback, and maybe this isn't enough. At this point, it's only safe to buy the stuff that's been completely mauled or could be coiled sprigs. If you stay tuned, I got 4 that you must track. My Charitable Trust, we're only touching stocks that have lost 10% of their value in a very short period of time. We did some buying today. We're not selling. Why? Because we got plenty of cash, and we like it when the market comes down so we can put it to work. Are we in a this too shall pass moment? Sure, but the this too always hurts, especially it not hurts the Eagles quarterback. That hurts, too, especially because then you have to get used to hearing that Jay Powell must raise interest rates to whip inflation now, which means these people want him to trash the economy in order to save it from inflation. If you can't take the pain, it's not too late to sell something, but please only on a bounce, as long as you're nimble enough to get back in at a lower level. But the bottom line, the idea that everything will continue to be awful, that all 6 of these dice rolls will come up snake eyes, no, that's too easy. Something will go right with one of these. It almost always does. The sell-off will eventually right itself. I just think it's worth waiting on the sidelines with new money until we figure out how things can turn around, or your favorite stock gets clobbered to the point where it's too cheap to ignore, like the brutal meltdown in Micron after the close.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.